Welcome to File 1. This is going to be talking about return measures, but before we start with return, let's look at an overview of what your learning goals are. I'm going to discuss 3 types of risk attitudes, so you should be able to discuss each of them. You should be able to define something called systematic and unsystematic risk. You should be able to define return and its components. You should be able to define expected return, define the dividend model form of return, define security market line measure of return, and finally define holding period return. And in terms of holding period return, File 2 will be using that, so you should be familiar with the calculation. So we're going to start with risk attitudes. People can be lovers of risk. They get excited by gambling. The reverse could be risk avoiders. They want to just leave their money in the bank. They're afraid to get any chance of loss. And risk neutral people are those that are aware of risk, but they don't perceive any changes in risk, and therefore compare things based on return. So are we a risk lover, a risk avoider, or risk neutral? Let's look at the example below and decide who would prefer one of these two choices. So in choice 1, you pay $100 and you get back $200 for sure. No risk, and you're making a $100 profit. Choice 2, you pay $100 and have a 50% chance of receiving nothing back, losing your entire $100, and 50% chance of receiving $400, that's $300 more than you would have had. So if we do 50% of 0 and 50% of $400, the expected payoff is $200. So in both cases, the expected payoff is $200. Choice 1, it's $200 without risk. Choice 2 is $200 with risk. So which of the 3 risk attitudes would choose number 1? If you chose the risk person or risk avoider, you're absolutely correct. Who would do choice number 2? Well, if you chose risk lovers, you'd be right. But what about the risk neutral person? Does he see any difference between these two? And the answer is no. They both have expected payoff of $200. So he would be risk neutral. In this case, he would be indifferent between the two. Okay, let's talk about risks and categorize them into 2 categories. Let's call them market-related risks. These are things that influence the entire stock market. All stocks in the stock market are affected to some degree, causing prices to rise and fall. We've certainly seen a lot of this in the month of December of 2018. Business-related risks are kind of unique to the company or unique to the industry, but the rest of the economy, the rest of the stock market is not affected. Business risks also cause prices to rise and fall. I'm calling these risks market risk and business risk. In a couple of moments, I'm going to call market risk systematic risk and say it's undiversifiable, because if you buy any stock in the stock market, to some degree you're going to have market risk. The other type of risk, business risk, I'm calling unsystematic. It does not pervade the entire economy, and it is diversifiable. Buy a different stock, you have different business risk. So that's one way. The other thing you can do is if you buy a very large number of stocks, each individual stock's risk is very small, and we call that diversifying the risk. We can think of return as being compensation for just simply investing with no risk at all. This is the risk-free rate. And you can think of this as buying a 3-month treasury bill. You buy the treasury bill, or 6-month treasury bill for that matter. You buy the treasury bill, you know the interest rate you're going to receive over that time period, and you know the government's going to pay it for sure. So it is risk-free in the sense of you know the return as well as you know you're going to get paid. Now, if you is systematic risk, if I said to you, why don't you take your money out of the bank, put it into an exchange trade fund for the S&P index, or exchange trade fund for NASDAQ, or some other exchange trade fund that's very well diversified, then your only risk you'd have would be systematic risk. So there's got to be a reward for taking on systematic risk. We call this the premium for systematic risk. So the question becomes, in order to get investors to leave the comfort zone or a treasury bill and take on systematic risk, how much return would they have to have? And we call that premium, the premium for market risk. In my little example, I'm going to assume the premium for market risk is 4%. The treasury risk-free rate is 3%. So if I combine those two, the investor would expect to get 3% plus 4 additional percent for leaving the treasury bill and going into a very diversified exchange trade fund. Suppose we said that you wanted to buy, in addition to that fund, a single stock. Well, that single stock would have business risk or unsystematic risk, as we're calling it, and so that you'd have to have an additional return. So based on the additional business risk, the investor would say, I need extra return or premium for business risk. And let's say, for example, 3.5%. So you'd be getting 3% for the treasury bill, 4% for the willingness to go into a diversified portfolio, and you'd need another 3.5% to invest in a specific stock. That would bring it up to 10.5%. So what are the components of the return? It's the risk-free rate plus a premium for market risk plus a premium for business risk. Repeating it a different way, it's the risk-free rate plus a premium for systematic risk plus a premium for unsystematic risk. So let's take this example I just verbalized before and put it in the screen where you can see it. Investor earns 3% for owning a treasury bill. The investor buys an exchange traded fund on the S&P index. He would have to expect to receive 7%, or he probably wouldn't make the investment. An investor, in order to buy an individual stock in the S&P, would say, I need at least another 3.5% above the market risk to cover the business risk, and that would bring us to 10.5%. So let's begin looking at three measures of return. The first is called stock return based on the dividend model, and you're going to learn about the dividend model in Chapter 7 in probably the second week of February. So let's just simply define the dividend that we're going to receive in the future as the expected dividend, and let's say it's going to be at the end of the year 2019, and we'll designate the subscript 1, D1, with the subscript 1 being dividend 1 year from now. Let's say we think it's going to be $2.25. The price grows at the same rate as dividends grow. This is designated by G, so we can look at past growth of dividends and say, well, dividends have been growing at 6%. We expect the price to also grow at 6%. We'll understand more why when we get to the Chapter 7, but let's take it for that for now. The stock market price today is P0. 0 is 0 years from now, is $50. So what's the expected return? It would be the dividend divided by price, which is dividend yield, plus G, the growth rate, or the capital gain yield. So in this particular case, the dividend yield would be 4.5%. The capital gain yield is another 6%. The total return is 10.5%. So we would say that return of 10.5% covers the risk-free rate, premium for systematic risk, and a premium for unsystematic risk for this particular stock. The capital asset pricing model, which has a specific return measure called the security market line return measure, will be talked in greater detail in actually be Chapter 5, not 3. And the return is measured by R, and the subscript C is simply a specific company. Let's say it's company C. RF is the risk-free rate. RM would be return in the stock market in general, what the average stocks and the return, or what an index would be giving you as a return. E is the expected return for the future, so the premium for market risk or premium for systematic risk. Yes, that's a telephone and somebody's calling the house. I'm not answering it. The premium for systematic risk would be ERM minus RF, or 7% minus 3%. So you're getting 4% premium for systematic risk. And beta is the amount of systematic risk. In this case, a beta of 1 means exactly the same risk as average. Beta less than 1 is less risky than average. And a beta of greater than 1 is more risky than average. So this is 1.2, about 20% more risky than average. So you'd get an additional 20% more premium. So you're going to get 1.2 times 4, which would be 4.8, plus the 3 would give you a return of 7.8. The key thing we want to talk about with the security market line is you see there's a premium for systematic risk, but there's no premium for business risk. The assumption is everyone is well diversified and therefore do not experience unsystematic risk, so there's no reward for unsystematic risk. So we're going to turn to the last one, which is holding period return, which is a past return. And we basically say that given the past return, we'd expect a similar return in the future. So the holding period return is simply the change in price plus dividend divided by price. So if I write it down as P1 is the price 1 year from now, or 1 month from now, or 1 week from now, P0 is today's price, then the return would be the price I expect to sell it for plus the dividend minus the price I paid, so that would be the gain plus dividend, divided by the price I paid. So if we kind of look at past data and say, well, on January 2nd, the price was $47, January 15th, it was a $2 dividend, and by February 1st, the stock had risen to $50. So we would say in this case, what is the holding period return for the month of January? It would be $52 minus $47 divided by $47, or about 21.27%. So that would be the monthly holding return. Then you could calculate from February to March, March to April, April to May, and so forth. And you would have a series of holding period returns. And in files 2 and 3, we'll learn what we do with that kind of information. Okay, I'll see you then.